Chapter 2: Debt. Debt facilities are used to fund the medium to long-term objectives of the company. When assessing the debt capacity of a company, treasurers and lenders need to focus on the strength of the balance sheet and the existing cash flows of the company. The most common types of debt facilities are amortizing term loans. These facilities are usually provided by banks. They entail the payment of contractual amounts of interest and capital to the lender in order to gradually repay the loan over its life. These loan repayments can be sculpted to match the cash flow generation profile of the company. The most common use for amortizing term loans would be funding expansion projects where the amortization profile of the debt would be sculpted to match the cash flow profile generated by the expansion project. Typical tenor would be 5 years. Revolving credit facilities, or RCFs. These are debt facilities also usually provided by banks and have the mechanism whereby they can be paid down and redrawn up until their maturity date. Upon maturity, all outstanding amounts would need to be repaid. Borrowers pay an interest rate on all amounts drawn on the RCF and pay another interest rate, called a commitment fee, on all undrawn amounts of the RCF. The most common use of RCFs is for medium-term funding for relatively mature companies. Typical tenors range from 3 to 5 years, and these companies usually desire the flexibility to pay their facilities down during times of surplus, but then redraw them when necessary. They are useful for companies wishing to have contingency funding in place for strikes and other production interruptions. Corporate bonds. The lenders here are individual investors who provide capital to a business in return for a promise to receive periodic interest on that capital and eventually receive their capital back at the maturity of the bond. The bond issuer then uses this money for general corporate purposes. The investors receive a periodic interest payment, called a coupon, and at the maturity of the bond, the investors receive their invested capital back, either at a discount, which is lower than the face value of a bond, at par, equal to the face value of a bond, or at a premium, higher than the face value of a bond. Companies would issue bonds either on an exchange or directly to a pre-selected group of investors through a private placement. Large corporates may issue bonds in the market periodically, for instance, once per year. In this manner, each of the bond issuances would mature 1 year after the other, thus mimicking an amortization profile. The most common use for corporate bonds is for medium to long-term funding. Typical tenors are between 5 to 7 years, with the ability to reissue the bond at maturity, effectively rolling over the bullet payment. To refinance existing and more expensive debt, corporate bonds are often used, and they form the core of a company's capital structure. The lump sum nature of a bond would benefit a mature company that has a steady cash flow profile. Corporate bonds need to be relatively homogeneous in order to attract masses of individual investors. In other words, they are structured more for the market than they are for the issuer. This is different to bank debt, where the funding relationship would be between the company and its bankers. The bankers would differ from bond investors in that they would endeavor to develop a deep understanding of the company and structure a very bespoke funding solution suited to the individual needs of the company. Furthermore, in the event of a default, banks are significantly more flexible than bondholders, especially when it comes to negotiating remedial actions for the company to take to cure the default. Convertible bonds. These are corporate bonds that carry a fixed coupon. However, in addition, they also offer the bondholder, or bond issuer, the option to convert the bond into a set amount of shares in the issuing company. The uses of convertible bonds are the same as for corporate bonds, but in addition, convertible bonds usually pay a lower coupon than normal vanilla corporate bonds. If the issuer's share price appreciates in future, the convertible bondholder would convert their convertible bond into equity, thereby eliminating the need for the issuing company to repay a bullet repayment at the maturity of the bond. Typical tenors range between 5 to 7 years, and similarly to corporate bonds, convertible bonds tend to be structured very homogeneously in order to be able to attract masses of investors. They are therefore not very customizable to the individual needs of the issuing company. Asset-based financing. This is a form of ring-fenced financing used for movable assets such as vehicle fleet or office equipment. There are two main types of asset-based financing, namely finance leases and operating leases. Leasing allows for companies to enjoy the benefits of using equipment without having to raise large amounts of cash in order to purchase it upfront. Recent accounting standards have been amended to treat finance leases and operating leases equally. The equal treatment of finance and operating leases has helped to standardize the recognition of assets and liabilities across all companies, making it easier to compare their financial statements with one another, regardless of whether they choose to own their assets at the maturity of their leases or not. For a finance lease, the party wishing to acquire the use of the equipment, called the lessee, would pay a series of installments to the owner of the equipment, called the lessor, in return for having the use of the equipment. The installments would be structured to cover the value of the equipment, plus an interest charge. Once the lease period was over, the lessee would own the equipment outright. The lease payments could be structured to match the cash flow profile of the lessee, having small, regular installments over the tenor, with one final large payment at the end. This large final payment is often referred to as a balloon payment. During the tenor of a finance lease, the costs of maintaining the equipment are borne by the lessee. For an operating lease, the lessee would pay the lessor for the use of the equipment. However, at the end of the lease period, the equipment would be returned to the lessor. During an operating lease, the lessee would usually be able to upgrade or replace the equipment leased from time to time, thus always keeping up to date with the latest and newest technology available. This is usually the case for leases involving electronic and office equipment. During the tenor of an operating lease, the costs of maintaining the leased assets are borne by the lessor.